In March 2020, silver fell more than 35% in less than 3 weeks before doubling within months, and the mechanics driving last few days' moves look uncomfortably familiar. If you're watching silver right now and feeling like the price action doesn't make sense, that's because it doesn't, at least not if you're looking at it through sentiment or fundamentals. What we're basically watching is a breakdown in how silver is being priced under stress. Over the last several sessions, everything has been falling at once. Gold, silver, equities, crypto. When correlations move toward one, that's rarely about opinion. It's about liquidity. But silver's behavior stands apart because of how extreme and mechanical the moves have been. The gaps, the violent intraday reversals, the price snapping back to the same zones again and again. That doesn't come from fear. That comes from structure. Silver trades across fragmented venues, Shanghai, COMEX, and the physical OTC market. In calm conditions, arbitrage keeps those prices aligned. Under stress, that alignment fractures. The Shanghai Futures Exchange has hard daily limits of roughly 7%. When silver hits limit down, trading halts. Liquidity doesn't disappear, it gets trapped. Chinese buyers and sellers are frozen in place, while the rest of the world continues trading. When that happens, global price discovery is forced almost entirely onto COMEX. At the same time, margin pressure is rising fast. In just days, margin requirements on precious metals futures were raised sharply. Maintenance margins jumped roughly 36% for silver, 33% for gold, 25% for platinum, and 14% for palladium. Those increases don't reflect fundamentals. They reflect volatility and risk management. When margins rise that quickly, leverage players have only one choice. They have to raise cash. In forced deleveraging, funds don't sell what they want to sell. They sell what they can sell. Gold and silver are liquid, profitable positions that can be monetized immediately, which makes them the first source of cash when margin clerks come calling. With Shanghai halted and margin pressure rising, COMEX absorbs nearly all the stress. Volumes surge while depth collapses. In prior stress events, COMEX silver volumes have jumped 30 to 50% above average, while bid depth thins out dramatically. That creates a vacuum where prices can overshoot without resistance. That's where the extreme paper prints come from. The spikes into the high 80s and 90s weren't reflections of physical clearing. They were derivatives reacting inside a liquidity bottleneck. Then Shanghai reopens. When it does, the arbitrage gap between a frozen price and a live market has to close quickly. That adjustment tends to pull price back toward the last level where two-way liquidity actually existed. In this case, that has consistently been the high 70s to low 80s. That snapback is the tell. It says that while paper markets are swinging wildly, physical supply and demand are still clearing in a much narrower range. We've seen this before. In March 2020, silver fell more than 35% in less than 3 weeks. Gold dropped about 15%. That wasn't because their long-term role failed. It was because liquidity was scarce and leverage had to come out of the system. Once policy support arrived and forced selling ended, silver rallied more than 100% over the following months. The mechanics today is in line with it, even if the macro backdrop is different. The S&P 500 is expensive by some metrics, but not all. Forward price-to-earnings ratios are elevated, but they are still below the extremes seen in 2000, when forward multiples exceeded 25 times while margins were far weaker. Today, operating margins remain near 12 to 13%, which materially changes valuation comparisons. More importantly, true systemic liquidity crises show up in the plumbing first. Repo markets seize, commercial paper spreads blow out. Dollar funding strains appear. Those signals were obvious in 2008 and visible in early 2020. So far, they remain comparatively orderly. What we are seeing instead is localized liquidity stress, and silver is where that stress shows up first because of how its market is built. This is classic forced deleveraging, not a fundamentals reset. The signal to watch isn't whether silver rallies tomorrow. It's whether silver stops making gaps while equities continue to bleed. Historically, that is when forced selling ends and real bottoms begin to form. Until then, downside extensions remain possible. There is meaningful structural support lower, potentially in the mid-50s to low 60s, if deleveraging intensifies. On the upside, resistance sits much higher, but that only matters after liquidity normalizes. The key point is simple. Bottom line is, silver isn't broken. S being used as a liquidity source inside a stressed system. And when that pressure is finally released, the move won't be driven by emotion or headlines. It will be driven by mechanics, just like the sell-off was.